Welcome back to Management 720. Let's get started with Chapter 7. Before we get going on the learning objectives, let's sort of put this chapter in context. Where have we been before? So we spoke at the beginning of Chapter 5 that this textbook is sort of divided into three sections of 4 chapters each. And that's how the exams are done as well. Chapters 1 through 4 were short-term decision-making chapters, and we learn fixed costs, variable costs, contribution margin, and then we use those to calculate things such as what is break-even or other special decisions such as should we outsource, etc. These middle 4 chapters are about cost and pricing, getting better at costing so we can be better at pricing. And then the last 4 chapters are based on long-term decision making, and when we get there we'll learn about budgets and things such as that. So in these middle 4 chapters, chapters 5 through 8, notice there's a pattern here. Chapter 5, we talked about job order and process costing. And what did we focus on? We focused on the fact that indirect costs are captured by, if you remember, and we're going to have an exam coming up, so hopefully some of these will seem familiar, the predetermined overhead rate. That's what we use for job costing. And conversion costs for process costing. In Chapter 6, we looked at plant-wide, department and activity-based costing. And again, we were trying to capture indirect costs. Now we've moved into Chapter 7. We're going to look at production versus service departments. And again, we're going to have 2 different methods, a direct method and a step method, for capturing the indirect cost of service departments. And of course, we're going to learn more about what that is. But the pattern you should be seeing here is that in order to be good at costing and therefore pricing, it's all about capturing and having different methods to capture the indirect costs. And we'll talk a little bit more about that towards the end of this chapter. But that is that's one of the hardest things to do, and that's why we focus so much time on it. Capturing indirect costs is a difficult thing to do, and we've got many different methods to do it because there are many different types of businesses and many different types of production or industries out there. So let's move on to actually learning Objective 1. What is the difference between a production and a service department? A production department, and again, we're mostly talking about manufacturing type businesses, although any of these costing exercises can apply to both service and merchandising type firms. But usually when we're talking about cost accounting or managerial accounting, we're usually phrasing it in terms of a manufacturing or production type environment. So a production department, such as assembly or finishing or some sort of actual hands-on materials, production department performs the actual work on the product. And that makes things a little easier because a majority of those costs are direct, such as labor and materials. And in a previous chapter, we talked about direct labor and direct materials. Those are traceable to the actual product. In other words, if we want to know how much cost each of these inventory items bear, we need to be able to trace the cost to them. So direct labor, people who directly work on the product, and materials that go directly into making the product, are fairly easy to trace. It's all of the indirect costs. And so even in a production department, there can still be indirect costs. A supervisor, you don't really trace that to individual items or individual inventory items. You may just take the supervisor's salary and divide it amongst the existing items rather than tracing it directly. So production department has mostly direct costs, but there are indirect costs, both material and labor. A service department, and what is that? Well, they provide support. They provide support for production. And in other terms, maybe you've heard it in one of your other classes, as it's being a cost center rather than a profit center. A cost center means it doesn't really face the customer. It's there to help the other departments do what they need to do to service customers. So what are they? payroll, IT, maintenance, HR, security. There could, depending upon the industry that you're in, there could, R&D. There could be lots of different service departments. So service departments provide support functions, and sort of by default or by definition, because they're not working directly on the product, they're helping other departments, both service and production departments. The costs are indirect. So what type of costing system? If we're using a plant-wide rate, which is what we learned in the last chapter, all indirect costs, both the production and the service department costs, all get rolled up into one rate. So there's really no differentiation, and you don't capture any of the the particularities of either some of the different production departments or the different service departments. But if we're moving to a departmental rate, which is something we have discussed before, service department costs get allocated to the production. Now remember, production is working directly on the product, therefore a lot of it's direct. What we do is we take all the indirect costs of the service departments, and we find a way, depending upon what type of service these different service departments do and how much each production department uses, we somehow allocate the indirect costs of the service departments to the production departments. And we do that through one of two methods, either the direct method or a step method. And we'll talk about an additional method, but we are not actually going to cover it in this chapter. So this chapter is fairly straightforward. The amount of homework problems that are calculation are a little less than in chapters 5 and 6, and 8 will probably be even less so. So as I mentioned before, 5 and 6 was the majority of calculation. 7 has some, 8 has a little less. And the two that we're going to focus on are the direct and the step method. So let's actually talk a little bit about the two methods. So the first method, direct method, is, and we should be fairly used to this now, each service department has a cost driver. And the cost driver can be something that pretty well describes the activity of that department. So it's important that the cost driver matches the type of work that the department does. For example, if you are quality control department, then probably the number of inspections is something that would be a good cost driver for you, rather than machine hours or something like that. So let's take a look at the numbers here. We've got 3 service departments: support services, engineering, and building and grounds. And they each have a certain amount of cost. This one has $27,000, this one has $20,000, this is $10,000. And we've got 2 production departments. What we need to do is we need to move the 27, the 20, and the 10 over. We need to allocate those costs by some method to each of these 2 production departments. And so the direct, I guess once you see the step, you'll understand the direct doesn't interact with the other. Each service department just deals directly with the production departments. There is no interaction between the service departments. So here, remember, each department is going to have its own cost driver. The cost driver here, and of course they call the cost driver, they always have to have a new name, they call it the allocation base, is capital investment. Now, we're not using these numbers. This is just the numbers that we come up with, the percentages. If mixing uses $180,000 of capital investment and bottling uses $270,000, well, that's a 40-60 split. A 40-60 split on the thing that we're using to allocate. And so we're going to allocate the $27,000 of cost on a 40-60 split. And that's where we get the $10,800 and the $16,200. And so you see here, support services is done according to this allocation. It is a 40-60 split, and therefore the $27,000 gets allocated on a 40-60 split. Same with engineering. Engineering is done on a more common type of thing, number of employees. There are 80, and the 2 departments, the 2 production departments have 24 and 56, and that comes out to a 30-70 split. So of this 20,000, we're going to split that 20,000 between the 2 production departments, 6,000, 14,000, or a 30-70 split of the 20,000. And you can see that down here, the 20,000, 6,000, 14,000. And the last one is, well, we have 10,000 that we need to split up. How are we going to do it? We're doing it based upon square footage. The square footage between the 2 production areas are 11,000, 33,000 for a total of 44. That's a 25 and 75% split. So we're going to split the 10,000 in a 25%, 75% split. So you can see the direct method is, as long as you know what your allocation is, you figure out your split. That's how you're going to split the cost of that department between the two production. And each one has its own allocation base, and therefore you have to figure out the split slightly different for each one. But in the end, this is what you need to have. You need to move this 27, this 20, and this 10 over to these two departments in a, I don't want to call it fair, but an accurate way, right? That's what you're trying to do, is figure out how much cost each of these departments use, so that when you come out to figuring out the cost of the end product, you have a better sense of how the costs split up. Okay, well, let's go ahead and look at the next method, and that's going to be the step method. Okay, so here we have the step method, and it's essentially going to be the same. And you notice that we actually have somewhat the same numbers here. We've got 3 departments: engineering, support, and building and grounds, and we've got 2 production departments: mixing and bottling. But you're going to notice that the numbers, there's going to be a few extra numbers in here. And that's because the step method is an improvement over the direct method, because what does it do? It recognizes that some service departments, or I guess I should say, it recognizes that service departments just do not serve the production departments. Sometimes they support each other. For example, IT supports payroll and HR as well as production. So not all of the costs from IT go directly on to production. Sometimes they get applied to some of the other service departments. Now, how does the step method take this into account? It does this sequentially. So meaning you start off with the first department, and if it has any interaction with the other 2 departments, so if we call this support number 1, if it has any interactions with support 2 and 3, then we apply those costs. And as you can see, engineering resource does have some interaction with support and building and ground. Some of its 20,000 actually goes to support services and building and ground, and then the rest goes to the 2 production. But just remember, the 20,000 is made up of all these 4 numbers. Now, when we go to the second one in sequence, notice we don't go backwards. We don't say support also does some support services for engineering. You notice that there's no number here. We only kind of work downwards in the sequence. So once we're done with engineering, there's no going back and applying any cost there, because then you would form kind of a weird loop. In other words, if I applied some of support services to engineering, well, then that would mean the engineering would have to redo these numbers. So we go in one direction and it's sequential, and usually the problem tells you, or if the problem doesn't tell you, just assume it's according to how they've labeled service department 1, service department 2, service department 3. So here they've listed them in descending order. So engineering supports not only the support services and building and ground, but also the 2 production department. The support services only supports the building and ground plus the 2 production, and buildings and ground only supports the 2 production. So you notice it doesn't support either of these. And we'll talk about, well, what happens when you do have these other sort of linkages. That's the next method that we don't use, but we just discuss. So, okay, you'll notice again that we have to have an allocation base, and we have to have a way to take this 20,000 and divide it amongst all these things. Now, here it says the number of employees for the engineering resources. Now, notice that it doesn't take its own employees as part of the total. It just takes the things that it's servicing, the departments that it's servicing. So it only takes the support services, the building and grounds, and the 2 production. It takes those 4 employees as a way to figure out what is the amount. So it looks like those 4 must add up to, let's see, 20, 44, adds up to 100. So these are actually 15 out of 100 employees, 15%, 5%, 24%, 56%. And that's what we see here. Now notice that when we move down to support services was originally 27,000. But because it's absorbed 3,000 of the cost from engineering, it is now 30,000. So we have 30,000 for cost allocations, of which 27 was its original amount and 3,000 was cost passed on to it by the engineering resources department. What is its its allocation base, its capital resources? And again, you only take into account for purposes of figuring out the allocation. You just take the allocation base of the here's the three departments that it's servicing. It's servicing the last service department and the two production departments. So you add these all up together and you divide by, so this would be 180 plus 50, that'd be 270. So this looks like it's 500,000. So 50,000 out of 500,000 is 10%. So 10% of the 30,000 is 3,000. 30%, 36% of the 30,000 is 10,800, and so forth. So notice here, okay, we've placed the 3,000, the 10,800. Now the 10,800 and the 16,200 go to the production departments, but the 3,000 gets passed down to buildings and ground. So buildings and ground started off at 10,000. It absorbed 1,000 from the first service department, engineering resources. It absorbed 3,000 from the second service department. So its total costs are 14,000. 14,000 and its allocation base is square footage. Now remember, you only take the allocation base of the departments you're servicing, not your own department. So here the two square footages are 11 and 33,000, so 44 total. So again, 11,000 out of 44 is 25%. 33 out of 44 is 75%. So we're going to allocate this 14,000 on a 3,500 and a 10,500 basis. So you can see when we do it the step method, we do some of the departments pass their costs on to some other support departments, but it's not every which way, it's only sequential. In other words, the first one passes it on to the next two, the second one only passes it on to the third, and the third doesn't pass it on. It just sends all its costs to production. So they're approximately the same. There is a little bit of extra work with the step method. That's why when we look at the homework, there's going to be only one or two direct method. There's probably going to be 3 or 4 step method, just to make sure we get practice with the step method. Well, that's the majority. We do have some ratios a little bit later on in the chapter, but that's the majority of the calculation. Let's go pass on to some of the other knowledge-based items in this learning objective list. Okay, so learning objective 3, it's an interesting thing. Lean manufacturing and just in time, plus a whole lot of other sort of cost accounting or manufacturing theories. This is actually a very big topic, and we just cover some of the sort of the basics here. If this is at all interesting to you, or if you are going into some sort of production type company, then you'll probably end up learning a lot more about this. So the granddaddy of all of these sort of production systems was the Toyota production system. And I actually went to, a 4-month-long in-factory training session with the Toyota production system people in a different production system and went through and worked on the factory line and did all of this. So this is a lot of stuff I've had a lot of practice with. And so it's interesting to see what does the textbook want to pull out as the couple of items to cover. So what we're covering is just lean and just in time. And I don't know if they've made the explanation, but let me try an explanation of why they're just focusing on this. And so I've kind of thrown it out here. There's a reason we measure gross profit first when we're looking at the net income. And just to remind you, sales minus cost of goods sold equals gross profit. Then we take out operating expenses, and that becomes net income. And what is that? Remember, COGS, cost of goods sold, is just the inventory we've sold. So inventory and COGS is inventory sold. So I guess you could call the two of them, inventory is inventory not yet sold, and COGS is inventory sold. So it's the same stuff. It's just before and after selling. And for most companies that deal with product, The wholesale price of what they're selling is the biggest expense. And remember, that is an expense. Remember, an expense is defined as anything we use up to generate revenue. So when we sell inventory, the cost of the inventory is our biggest expense. And there's a reason, again, going back to the first sentence, we measure gross profit first. In other words, if you can't get your wholesale cost versus your retail price in line, then it doesn't matter how much other stuff you do. You're not doing a very good job at running your business. So COGS is typically the amount of inventory sold. It's our biggest expense. That would make sense. Remember, these middle 4 chapters are all about getting better at costing, analyzing our costs, and so that we can be better at pricing. If we want to be better at costing, wouldn't it make sense to focus on our biggest cost? And our biggest cost or our biggest expense is inventory. So the 2 things that we've pulled out here, lean and just in time, are 2 parts of the Toyota production system that focus in various ways on inventory. And so the Toyota production system here I've shown you is lean manufacturing, it's just in time, plus a lot of other improvements that deal with waste in the system. But these 2 focus on reducing the 3 levels of inventory. Now remember, the manufacturing inventory is raw materials, work in process, and finished goods. So how do these 2, lean manufacturing and just in time, interact with these 3 levels of inventory? In order to reduce raw material inventory, we can install a just-in-time system. A just-in-time system means we're not spending a lot of time ordering product. We don't have a lot of product sitting in the warehouse, or we don't have a lot of raw materials sitting in the warehouse. What we're doing is we're forming trusted relationship with our vendors, and they know our production system so well, and we have set up sort of a running or a standing order of product that they will bring raw materials onto the production line. Now remember, raw materials can also be components. So for like a car, maybe the car manufacturer makes the body, but it doesn't make the seats. Maybe you have a specialty seat manufacturer that does the specialty work on seats. And so the seat manufacturer knows how many cars you're doing that day. It brings just the right amount of car seats to fulfill your production, maybe that hour, maybe that half day, maybe it's a day's worth of inventory. But you can see where rather than having a bunch of inventory sitting in a warehouse for, you may order a month's worth of seats and have them sitting in the warehouse. If you've got a good just-in-time system with your vendor, they're delivering the materials necessary for whatever your production needs are that hour or that day. And that's what we call just-in-time. The vendors are delivering raw materials just in time for them to be used in the work in process. So how do you reduce work in process? Or what do these 2, lean manufacturing, JIT, have to do with work in process? Well, to reduce work in process, you want to reduce your production cycle time. So your cycle time is the amount of time that you actually spend processing or building or converting materials into finished goods. But there's a lot of other process time involved. There is sometimes you have to do setups on the machine. Sometimes you have to do maintenance. Sometimes there's downtime, depending upon the layout of your factory. Maybe there's time wasted moving stuff from one part of the factory line to the other. Now, the whole from when a product starts off on the production line and leaves the production line, that whole thing is called the cycle time. Now, maybe of that cycle time, only a small part of it is you're actually working directly on the product, and maybe a lot of the time is doing some of these waiting or setup or moving or that sort of thing. So lean manufacturing has to do with trying to reduce all of the other wasted time so that you're focusing as much of your cycle time on the value add, on just the processing. And when you do that, you reduce the amount of inventory that's in work in process, because when you reduce the cycle time, inventory moves through the work in process inventory more quickly. In other words, it goes from raw materials to finished goods much more quickly. Therefore, there's less work in process. And having less work in process or less inventory tied up in production is better for you. The last one, to reduce finished good inventory, if you end up succeeding in having a shorter cycle time, that means you're closer to a customer demand. In other words, rather than trying to build in anticipation of what the customer wants and maybe not gauging that correctly, the shorter your cycle time means that customers can demand stuff and you can almost build it right away, almost to customer demand. I mean, that's the idea. I remember when we were working with Nike, Nike was very big on lean manufacturing and worked very hard to get the shoe manufacturers over in Asia to implement lean manufacturing. And in fact, they would spend Nike was willing to spend a lot of money training people and getting factories upgraded. Now, it wasn't to reduce their cost, although that was a good outcome. What Nike really wanted was the cycle time. It wanted, because you have to remember, when Nike places an order to an overseas factory, that factory then has to schedule that, then it has to make the product, then it has to, the whole order run could take a while. Then they have to box it all, put it in a container. Then that container's on the ocean for a little while till it gets to the U.S. And when it gets to the U.S., then it needs to go out to all of the distribution centers before it gets to retail spots. Nike wanted to shrink that time because the faster they could get from when they ordered it to when it came to the distribution center meant they were much closer and had a more accurate idea of what customer demand was. So they wouldn't have to have sales on shoes because all the shoes they produced was the amount and quantity that customers wanted. And so Nike was willing to put a lot of money and backing behind lean manufacturing to reduce the cycle time, because reducing the cycle times means you don't have any unwanted inventory. And unwanted finished goods are called speculative inventory because you're not really sure of the demand. We also used to call it, instead of just-in-time inventory, we called it just in case. Just in case I need some, I'll make a little extra. But, a little extra a lot of times is not a good thing. So the whole idea of lean manufacturing and just in time is to lower the waste. One of the biggest waste is extra inventory or extra unneeded inventory and those carrying costs. So the idea of an inventory carrying costs is if you have inventory sitting in a warehouse, well, you have to have a big warehouse. You have to have utilities to run and air condition the warehouse. You may have product that goes bad, meaning it becomes obsolete and you have to throw it away, or you built it too late to where the customer demand has passed. There's a whole series of calculations on inventory carrying costs. But if you're focused on reducing inventory, it doesn't matter what your inventory carrying costs were before. You're going to reduce inventory carrying costs just by reducing your 3 levels of inventory. So that's sort of the quick and dirty. Like I say, this is a very big topic. If you want to know more about this, books have been written about this, and there's a lot to learn, and it's actually very fascinating if you're in that area of managing the inventory. Okay, so some extra information about lean and JIT, just in time. So as I've said before, if you can't manage it if you don't measure it. Or let's see, I think I actually say if you don't measure it, you can't manage it. That's probably the correct way of saying that. But let's take a look at some of the maybe counterintuitive outcomes of focusing on lean and just in time. With the goal of reducing inventory, you do have some cost savings because the less inventory you have to track, the less you have to put into a huge sophisticated inventory tracking system. So there are those costs again. So carrying costs go down and the inventory tracking goes down. And those are all good costs. But the way a company normally operates sometimes works against lean manufacturing and JIT. Let me just give you a couple of examples. It is normal for the purchasing department to try and help the company by driving down costs. And how do they drive down costs? They typically enter into large forward contracts where they are guaranteeing purchasing a large volume. But large volume purchases that drive down the per unit costs are kind of contrary to lean manufacturing. Now, there are other ways to set up your relationship with your vendor, and that's why I mentioned in the reduction of the raw materials inventory, you have to have a trusted vendor. And it's not only trust from the company to the vendor has to have trust with the company that even though we're ordering small amounts all the time, that it's going to build up to significant volume over time, even if we don't pre-order. We want to be nimble enough to say, okay, we need to switch, not vendors, we need to switch the type of product we're ordering from you because we have a new, for example, cars change a little bit every year. Every year is a season. And so, we don't want to have excess inventory for last year's car just sitting around that goes to waste. We want to be able to work with our vendor and be able to change the product as we go along and order in small batches necessary to meet daily production. So normal purchasing department rewards are based upon ordering volume that goes contrary to sort of lean manufacturing. Another thing that ends up happening is that the purchasing department may want to reduce costs by ordering raw materials that are lesser quality. Now, you may end up producing the product that you need to do on a daily basis, but remember, just in time is you're trying to meet customer demand as exactly as possible. If you have some bad product, what happens is it fails the quality inspection or there's warranties and you end up having a lot of rework or you have a lot of returns, and that's waste because then you need to redo it or you need to make more, and that throws off your whole, just-in-time system just enough to where it makes it costly. Also, if you remember when we studied fixed costs, we said it was best for a company to work as close to capacity as possible because the more units that you spread the fixed cost over, the lower the overall per unit cost is. And so a lot of times people, plant managers try to schedule as close to capacity as possible without realizing that you're going to potentially end up making more product than you actually need for your customer demand. So even though there are some, additional costs by not producing at capacity, the overall cost savings from minimizing the amount of extra wasted inventory overshadows that. And it's not always obvious because sometimes one person's in charge of one thing and another person's in charge of something else, and they don't see how sacrificing a little, for example, the plant manager not working at full capacity may feel like he's not doing a good job, but it ends up helping the overall company better because there's not extra inventory that's going to waste. So just be aware that sometimes there are things within the company that, unbeknownst to the company, are actually, they seem like good things, but they may be working against the lean manufacturing and just-in-time philosophy. So what are we looking for just in time? We're trying to reduce the cycle time from when, and you can see down here, we've got cycle time equals setup, processing, movement, waiting, inspection time. This is a for example. It's not every production line is exactly like this, but every production line will have one item or two items that is the majority of the good work or the majority of the value add. In other words, doing setup on machines, that doesn't improve the value of the product. Moving stuff from one line to another doesn't improve the value of the product. Only processing time. So what you want to end up doing when we look at cycle efficiency, what's the total cycle time versus the processing time? And as you can see, we would want this number to be as close to 1 as possible. In other words, we would want processing time to be almost all of the cycle time. So whatever the number we come up with, we would want to raise that number and have it approach 1 as much as we can. The other efficiency ratios is inventory turnover. In other words, annual demand in units versus the inventory in units. In other words, if I think I'm going to sell 1,000 of these and my warehouse can hold 100 over the year, in other words, I sell 1,000 and at any one time I can hold 100 in inventory. I've got to turn that inventory over 10 times, right? I've got to sell that 100, then fill it up with 100 more, sell it. Now, that means that particularly at any one time, we've got 100 units in inventory, and potentially some of those could be wasted ones. So what we want to do is increase our turns. So if we have 1,000 if we're going to sell 1,000 and the average inventory that we have in units, if we're running our just in time very well, maybe we just want 20 units, and that would cause our turns to go up. And the same thing happens here. Demand in units is the same as on a unit basis is the same as dollar basis as cost of goods sold. Cost of goods sold is the amount of product, it's the amount of inventory sold. So we would want both of these turns to go up. That would reduce the amount of inventory we have on hand at any one point. That means we'd be nimble enough to change directions if we need to change the volume we're making of any one product, or if we're going to actually change the product to a slightly different version. And then the last one is the gross margin return on investment. This is just gross margin dollars over average inventory. And I'll just point out one thing here. Average inventory, you notice this word average inventory, but they don't say average cost of goods sold or average gross margin. Just remember, going back to our financial statement stuff, cost of goods sold is on the income statement. The income statement is based upon 1 year, right? From January 1st to December 31st. Gross margin is also in the income statement. That's, in other words, cost of goods sold and gross margin, those two measures are over the period of 1 year. But inventory is on the balance sheet. Balance sheet is just as of the last day of the year. So if we want these two numbers to match, in other words, we want inventory to be the inventory over a year to match up with the cost of goods sold, which is over a year, we take the average inventory. So that means we take the ending inventory of the previous year plus the ending inventory this year and divide it by 2. That would be a simple average. There are different ways you can do weighted averages, but we're not going to get into that here. The last learning objective we have here is learning objective 5. This is just, I guess, again, some knowledge phrasing in the bigger context. So we've been focused so much on all this data-driven decision making, meaning for managing our costs, we've learned to rely on, there's more things, but these are 3 things I can pull out just from this last couple of chapters. We need to know our production process pretty well. We need to know what our departments are doing and how they're using costs. We need to be able, because we need to assign all these indirect costs, we need to have and understand what are good and useful cost drivers. And then we need to, of the different types of indirect cost allocation systems, we need to pick the right one for our particular business and our particular production. And so this relies upon a lot of data, knowing what we're doing, being able to apply it, and then using good judgment. We must rely on this data to help us make decisions. Now, the textbook makes an important distinction, and I'm just going to bring it up here. Sometimes people can get too far into the data and not understand what it means. That's the big thing with any data dive, is understand what it means. And so one of the most common, I guess, I don't say mistakes, but just things that people overlook is that there's the difference between causal and correlated. In other words, you may see 2 numbers rise and you think, well, 2 numbers for 2 different things rising in tandem. And you may say, oh, this thing is causing that thing. Well, things are not always that sort of direct causal relationship. Now, there's lots of little anecdotal stories people give. And so here's my little anecdotal story. If an alien landed on Earth and it was tracking smoke coming out of buildings and where fire trucks were, they would notice that wherever the smoke was coming out of the building, there also were a bunch of fire trucks. And so because both of those things seem to be co-located, the alien might say, oh, the truck is causing the smoke to come out of the building. Well, they've mistakenly made a causal relationship. The fire truck's not causing the smoke, right? It is a correlation, meaning they're both there because of a third factor. The third factor, of course, being there's a fire, right? The fire is producing smoke. The fire is also drawing the fire engines there. So be aware of making causal relationships when they're actually correlations, because once you've made a causal relationship, you may make the mistake of thinking, oh, if I adjust this, it'll automatically make the other thing go up or down. And within the context of my anecdote, you may say, oh, if I just prevent the fire truck from going to the smoke will stop. Well, no, that's obviously not correct, right? The fire truck needs to go to where the smoke is before the smoke will stop. So here's a list, and I think this is actually an interesting list. What are the skills gap in a lot of companies? And so this was done by the IMA, which is the Industrial Managers Association. I forget what it is, but it's a big association that deals with production. Here you've got a column of important to success, possessed by our team, and what is the gap. So you notice here right at the top are all these accounting things. Now we didn't study financial analysis, but that's, part of accounting. That's the top one, not knowing how to read and do your financial statements. But the next three are all things we're doing here: operational analysis, cost management, and the next 4 chapters we're going to do are budget and planning. And notice that important to success, your team has it, and these are all big gaps. So just be aware that you don't have to master all of these skills. You just have to be aware of how they interact with your businesses. And, in the real world, we don't memorize things all the time, but we have books, or we're aware of the issue so that when it's needed, we can go back and look up stuff. So that's part of coming through this MBA program, is being aware of what the issues are, having worked through several problems in each of these issues so you understand what's kind of the levers of each issue, and then being able to come back to it when you are presented with a similar problem in your real life working experience. So all the things we're working on here are hopefully useful to you in your future business. And for our homework, we've got 6 questions. And as I mentioned, we have one direct, a couple of 3-step methods, one on inventory ratios, and one on cycle time, which are all kind of the things that we discussed. So let's go ahead and take a look at, we'll start off on question number 10. And so questions 1 through 9 were more knowledge-based questions based upon the teaching of this chapter. All right, let's see. We've got our first homework here, which is homework number 10. It is a direct method question. And let's go ahead and take a look. Okay, always take a look to see what the question is asking for. Allocate service department costs. What is the rate for fabrication? Okay, so fabrication is one of the 2 production departments. Fabrication, and it says what is going to be the rate for them, and what does it base the rate? So fabrication and assembly are based upon direct labor hours, so let's just remember that. And the direct labor hours that we have for them are 8,000, right? 8,000. Now, fabrication has some pre-existing costs, right? So we're going to take its existing costs, and then we're going to add in whatever we allocate from the service department and the maintenance department to fabrication, add all 3 together, divide by 8,000 to get the rate. So let's take our first department. We have the personnel department, and it has 192,000 in costs. And what is its cost driver? Personnel costs are allocated based upon the number of employees. Now remember, the employees that we look at are only on the departments that it services. So in the direct method, each service department is just servicing the production departments. So we don't look at these 2 numbers, we just look at the 15 and 25 of the production departments. So 15 plus 25 is 40. Divide that out. How much is it per? It is $4,800 per employee. How many employees did fabrication have? Had 15. Multiply that out. Should come to 72,000. Now your numbers will be a little different, obviously. Now so of the 192,000, based upon a ratio of 15 to, the 15 to 25, that of the 192, 75 gets applied to fabrication. Now we look at the maintenance department, and it does its things based upon machine hours. It has a total of $360,000 in costs. How many machine hours? It looks like there's a total of 20,000 in machine hours. So divide that out and it comes to $18 per machine hour. Now fabrication had 12,000. So times 12,000 equals 216,000. So here is the fabrication department's original costs. Here's the amount that we're assigning it from personnel. Here's the amount that we're assigning it from maintenance. Let's add those three together. I get 624,000. And it wants to know not the total cost, it wants to know the rate. And the rate for fabrication assembly is based upon direct labor hours. We already said that up here. So if we take the amount of cost divided by the amount of direct labor hours, that should come out to, I get 78. Is that one of our numbers? And apparently so. Okay, let's go to the next. So this was question number 10. Let's go to question number 11. Okay, we have question 11. This is a step method question. So remember, whereas before the service departments didn't interact, now they do interact. So this is one format of a question, and we'll look at a different format with with question 12. Has two service departments and two production departments. So it says S1 serves S2, A, and B in the following percentages. S2 serves these other things in the following percentages. And here are the department costs. So again, before we get too far into it, let's just make sure we understand what they're asking. If it uses the step method, that's fine. And it begins with department S1, okay, because we need to know the sequence. First is we need to know its step method. Second, we need to know the sequence. What is the total amount of cost that will be allocated from S2 to department A? So it's asking us how much from S2 to department A. Well, because this is a step method, it's sequential. What we need to do is we need to figure out the cost allocated from S1 to S2, service department 1 to service department 2, and then we can figure out S2 to A. So it's asking what this number is, but we need to do this first. Okay, so let's take a look at department S1. It has S1, so S1, S2, A, and B. This is S1's amount of costs, 600,000. And how much of S1 does it apply to S2? Well, we go here. S1 serves department S2, A, and B in the following percentages. So the first one is S2. So of its 600,000, 15,000 gets applied to S2. So we're just going to multiply this by 15%, 600,000 times 0.15. So of the 600,000, 90,000 is used by S2. Now S2 has its own costs, right? S2, so if this is an order, S1, S2, so 600,000 is S1, 48,000 is S2. So 48,000 is its native amount of cost, plus it is absorbing the 90,000. So we need to add these two together. And that looks like that comes out to 138. So that's the amount of cost. It's its own 48,000 plus 90,000 of S1, of Service Department 1. Now, so we're at this point. We're at, okay, we now know the cost for S2, how much of it is applied to A. Well, we go back up here. Department S2 serves departments S1, A, and B. So the second one is A, so 0 and 70%. So 70% is the amount of its cost that it gets applied to A. So we're just going to multiply that by 70%. And I get 96,600 And that is one of the answers, which is always nice. And that is the correct answer. Okay, we're basically going to do this same question, but it's just going to look a little differently. It's always important to have, I guess, a little bit of track record that you know what's going on, even if the information is presented a little differently. Okay, here is, my stomach's rumbling a little. Here we've got question number 12. Let's take a look at it. Okay, so whereas the other one was almost all a word problem, here we've got a table. Uses two production departments, A and B, two service departments, S1, S2. S1, okay, we'll get into that. Let's first see what it's looking. Assuming S2 department is allocated first. Oh, so remember, as soon as we know it's step, we need to know what is the sequence. So whereas in the previous ones it was S1 and S2, they're throwing us a little bit of a loop. S2 is the first one, then S1 is the second one, which again, why even introduce such a silly little twist? But that's the twist we have to work with. Okay, so question number 12, it says, what is the cost allocated from assuming S2 department is allocated first, what is the cost allocated to S1 department A and B? Okay, so basically they're saying we need to figure out if S2, so it's a slightly different question. We need to figure out what is the amount of S2 and then how much gets allocated to S1 and to A and to B at the same time. Okay, so let's take a look at S2. Its total costs are $144,000. It is done on the basis of S2 costs are allocated based on direct labor hours. So direct labor hours, this one here. Now remember, okay, so this is, whenever we're using step, or direct for that matter, we do not include our own cost driver. We only include the cost driver of the departments we're servicing. So S2 has $144,000 of costs, and it's going to allocate those costs to the other three departments based upon direct labor hours. Therefore, we're only going to look at the direct labor hours of the three departments we're allocating to. So S2 is going to allocate to S1 and to the two production departments. So if we look at this, the direct labor hours are going to be 225, 1125, and 900. If I add those together, I get a total of 2250. So if I divide this by 2250, that is going to be 144,000. We're allocating this 144,000 based upon $64 every direct labor hour. So now it wants to know, well, how are we going to allocate it between the three departments? Well, S1 is 225 hours, well, times 64. Or 14,400. Production department A is 1125 times 64. Or 72,000. And department B is going to be 900 times 64. Or 57,600. Well, let's hope there's one that has, yep, this one. So amount service to the service department 1, 14,400, to department A, 72, and department B, 57,600. Well, I guess we should check. Looks good. Okay, we got one more step problem to do. Let's take a look at that one. Okay, so not quite the same numbers, but close. Let's see. Not close. I mean, I don't remember what the other numbers were, but I remember S2 was 144, so that's like half. Anyway, it doesn't matter what the numbers are. It's the same setup, but they're asking us a slightly different thing. So what are they asking us here? Assume S2 department are allocated first. Okay, so they're continuing with that. It's S2, then S1. And the cost allocated to service department from S1. Oh, so they're giving us a number. So what is the cost allocated to each of the two producing departments by service department 1? Okay, so the order is, the sequence is S2, S1, and then A and B. And they're wanting to know what is the cost allocated from S1 to these two. Well, normally we would take the 72,000. Normally we would figure out how much of S2 is allocated to S1, but it's telling us, it's saying 7,200 is that. You know what? Just to do all the numbers, let's go ahead and double check and calculate that. So if I wanted to find out how much from S2 is being passed on to S1, I would say it's a total of 72,000 in costs divided by, and S2 are allocated on direct labor hours, and it looks like the same direct labor hours, 225 plus 1125 plus 900. It is. So I guess the randomization number is only but so random, I guess. 2250, you may get really random numbers. So if I take 72,000 divided by 2250 equals, oh, it is exactly half, 32 per direct labor hour. And for S1 is 225 hours times 32 equals 7,200. So going from S2 to into S1 is 7,200. And what did they tell us? Well, they told us 7,200. Okay, so I didn't need to do that, but just to show you where that number is coming from, they calculated it correctly. So if we say for S1, what is passed from S2, so this is the amount coming in from S2. S1 has its own cost, 48,000, right? So we add those two costs together, 48,000 plus 7,200. It's going to come to 55,200. And that is the amount that we need to allocate to A and to B. Now, how does S1 allocate? S1 allocates based upon the number of employees. The number of employees. Now, remember, we don't count all the employees. We only count the employees in the departments we're servicing. S1 is only servicing A and B. So that's a total of 25 employees. So we take this number divided by 25 equals 2208. It's kind of an odd number. Let's see if it works out. So for each employee, it's $2,208. And we need to know both departments. So department A has 16 employees times 2208. And department B has 9 employees times 2208. $35,328, and this is 9 times 2208. These are odd numbers. Do I have them? Well, I do. Okay, let's check. And that's correct. Sometimes the odd numbers are correct. You just gotta trust the math. Okay, so make sure you understand what they're asking, and here they're giving you a little bit of the numbers. And these, I typically like to fashion the exam, the A and B level questions on something in the homework. So these last three step method are sort of fair game for questions and you will have seen it. The idea with the exam is hopefully you will have seen any question I ask you on the exam at least 2 or 3 times. One will be in the homework, one might be in the review, one might be in the quiz or something like that. But I don't want any new thing to pop up in the exam. I want it to have been something you've seen before. And of course, I would use sort of a reduced, I can't put this entire question in the exam. I got to do a reduced version of it. Okay, we got 2 more questions. Let's go ahead and knock them out. So here's question 14. The good news is those previous questions, 11, 12, and 13, are kind of the meat and potatoes of the homework questions. Those are the step method questions. Therefore, they're a little bit more difficult. These last 2 questions are more just ratio questions. Make sure you understand what the ratio is and what it means, but it's fairly straightforward. So let's go ahead and take a look at this one. All we want to know is what is the inventory turnover ratio and the gross margin. So we just need to know those 2 things. But there is one little trick about this. I did mention it in the lesson, but let's see what it looks like here. So this is question number 14. First one is the inventory turnover ratio. It can be in units or it can be in dollars. If it's in dollars, we need cost of goods sold, which is what they've given us. So it says, here's data for 2019 and 2020. What is the inventory turnover ratio and gross margin return on inventory? Well, okay, return on inventory investment. Oh, I see. I was going to say it's return on investment, but return on inventory investment for 2020. So they want to know it for 2020, yet they give us 2019 and 2020. So this is where a lot of people make the mistake. So remember, for the turnover ratio, also called inventory turns, the inventory turns is cost of goods sold over average inventory. Just to remind you what I said in the lesson, COGS is from the income statement, and the income statement is for a period of a year. Inventory is just from the balance sheet, but it's only for one day of the year. It's just for December 31st. What is the inventory on that day? If we want to match up the 2 time periods, in other words, if we want the numbers to match up the 2 time periods, then we have to take the inventory over the year from the beginning to the end of the year. So December 31st, 2019, that's the end of 2019, but that number is also the beginning of 2020. So if we wanted to know what the amount is for the average inventory for 2020, because we want to know what the inventory turn is for 2020, we're going to take the cost of goods sold from 2020. We don't even need to know 2019. That's irrelevant. We need 709,500 divided by the average of these 2 numbers, right? We need to average these 2 numbers. So we need to take 250K plus 180K, add those up, divide by 2. And so that number is going to be 709,500. And if we take those 2 numbers, add up and divide by 2, I can kind of eyeball them. It's going to be 215. Let me just double check. Let me see. 250 plus 180 divided by 2. 215, yes. 215,000. So 709,500 divided by 215,000 equals 3.3. We turn over our inventory 3.3 times during the year. Is that good or bad? Well, different businesses turn it over different at different amounts. For example, you expect milk to turn over very quickly. You may expect cars to turn over very slowly. So 3.3 it's relative. You have to know what the industry is and what we're looking at to know whether or not that's a good number or a bad number. But whichever case it is, if we implemented a lean manufacturing or a just-in-time system, is to drive the number of inventories up, because we want the amount of inventory, the average inventory, to go down. We want the amount of inventory we're holding at any particular time to go down. That would make these turns go up. Okay, so the next one is the gross margin return on investment. Remember that is just the gross margin in dollars over the average inventory in dollars. So we've already got the average inventory, right? We just calculated that. What's our gross margin? And again, it has to be the gross margin for 2020. They give you both you only really need both for inventory, because this is the one you need to average. These others, you just take the as of year, the 2020. So that would be 473 divided by 215. And that comes out to 2.2. And it looks like they want it in percentages. So remember, 1 is 100%, 0.1 is 10%, right? So 2.2 is 220%. So we've got an inventory turns of 3 and a return on investment of 220%. So we've got 3.3. Well, that's the wrong percentage. 3.3 and 220. So it's this one, actually. Check. My answer is correct. Okay, last one. And this last one is about, remember we talked about reducing the cycle time? Well, here's a little bit of information about how to look at cycle time, or this last question is based upon that. So we run 8-hour shifts, 3 different machines. Okay. So remember, cycle time is divided up into moving. There's quality control. They're setting up. There's downtime. And now remember, processing time is the amount of time that we find to be useful. We want to minimize, I guess I shouldn't say maximize. We want whatever the processing time to be, whatever, but we want to minimize all this other wasted time. So it's saying operations manager also noted on the average 1.75 hours of downtime. Okay, so it says, what is the cycle time per batch in hours? Well, we start off with the processing time is 3.5, then it's 2 hours. Now 45 minutes, well, that is 3/4 of an hour, right? 30 minutes is half an hour, and then it's 1.75 for downtime. So this entire amount is the cycle time, of which only this is the value add. This is the process time. And so we want to minimize this stuff so that the overall cycle time approaches 3.5. But let's see what's the total amount. 3.5 plus 2 plus 0.75 plus. So I get a total of 8.5. Let me just add that again. I think I fat fingered something. No, that looks right. So 8.5. And then what is our cycle efficiency? So cycle efficiency is just the amount of process time versus the total time. Now, as you can imagine, it's always going to be less than 1. We just want it to be, so I don't know what they're saying about 8.5. But in other words, the process is always going to be a smaller part of the whole. So here it's going to be 3.5 over 8.5. So I've got 0.4. It says 2 decimal places, 0.41. And we want it to, it would be great if it was 1. That meant that the entire cycle time only dealt with the value add part of processing, but there's always going to be a little bit of movement, batch quality control, inspections. We just want to minimize that as much as possible. Okay, well, that's all of the questions. And that finishes up for us for chapter 7. As usual, if you have any questions, let me know. And I will be putting out chapter 8 here shortly. And then next week we are on to exam number 2. And I will be posting the quiz for that before the weekend, so that everyone can get a running start on that. Okay, any questions, let me know. Have a good one.